Welcome to this explainer. Today, we're diving deep into a massive, cascading domino effect that is quite literally rewiring the global economy. We're looking at India's 2026 macroeconomic crisis, a situation entirely triggered by a colossal exogenous shock in West Asia. It's a shock that started what analysts are now calling the economic clock of war. We're going to track the exact chain reaction here, starting from a massive geopolitical flashpoint in a vital ocean strait, all the way down to the local monsoon weather threatening domestic agriculture.
Okay, let's dive right into this roadmap. We've got 6 acts to cover today. We'll start with the global ignition point, examine the rupee's identity crisis, explore a major trade paradigm shift, look at the historic battle between retail and foreign investors, factor in a severe climatic wildcard, and finally, map out the post-2026 economic order. Let's get right to it.
Starting off with Section 1, the global ignition, the exogenous shock and the Strait of Hormuz.
To really grasp the immediate urgency of this crisis, you have to wrap your head around this number, $126.41. On February 28, 2026, the Strait of Hormuz was closed following a severe escalation in West Asia. And just to remind you, that's a maritime artery handling 20% of global oil and LNG. That closure effectively shut in 13 million barrels of production capacity. By late March, Brent crude hit a staggering peak of $126.41 a barrel. Make no mistake, we are talking about the absolute largest disruption to the world's energy supply since the 1970s.
Look at how rapidly this escalation happened. We were sitting at a pre-conflict baseline of $65 a barrel on February 20th. Just 8 days later, the air war commenced and it jumped to $83. And then we hit that record $126 peak by March 27th. The economic clock of war is ticking down fast, heavily constraining global economic tolerance. We're looking at a cumulative global deficit of nearly 1 billion barrels of oil relative to pre-war expectations. It's a massive, massive shock.
So, the crucial point for us is how this global macro event hits the microeconomy of an energy-dependent nation like India. For the intellectual observer, this isn't just about paying more at the gas pump. It is a profound structural threat to the industrial base via what economists call the crude loop benzene cycle. This is a vicious cycle where $120 plus oil expands the current account deficit. That deficit weakens the rupee, and a weaker rupee makes buying that exact same oil even more expensive, which completely supercharges an inflationary spiral.
Which brings us nicely to Section 2, the rupee's identity crisis, 95.33, and the legacy of the Fragile Five.
So in early 2026, the rupee hit a record low of 95.33 to the US dollar. Now it's supernatural to have flashbacks to 2013 here, the infamous Fragile Five era, when emerging market currencies were collapsing left and right. But there is a massive technical shift between then and now. The 2013 crisis was the taper tantrum. That was mostly a reaction to the US Federal Reserve signaling a change in their monetary policy. But this 2026 crisis at 95.33, this is a twin deficit crisis. It's a simultaneous structural deficit in both the current and capital accounts, driven squarely by that enormous energy shock.
And we can see a fascinating global divergence playing out here. Over a 12-month period, the Indian rupee dropped over 12%. But look at Brazil, another former Fragile Five member. The Brazilian real actually appreciated by nearly 13%. Why? Because they are a net energy and agricultural exporter. The big takeaway here is that fragility is no longer just some broad emerging market trend. It is now highly localized to energy-dependent nations that frankly failed to displace manufacturing rivals like Vietnam or Bangladesh. Moving right along to Section 3, the trade paradigm shift, Section 122 and the Supreme Court pivot.
Let's talk about a major legal and geopolitical twist that happened on February 20th, 2026. A landmark U.S. Supreme Court ruling actually struck down the 50% tariffs that had been imposed on Indian goods under the IEPA. In response, the U.S. administration aggressively pivoted to Section 122 of the Trade Act of 1974. They replaced that complex web of reciprocal tariffs with a temporary, uniform 10% global surcharge. So on paper, Indian goods went from facing a 50% barrier down to just a 10% barrier. Sounds like a massive win, right?
Well, actually, no. The data tells a totally different story. Despite those lower tariffs, India's trade surplus with the U.S. didn't grow. It narrowed from over $40 billion down to $34.41 billion in FY26. What this means is that the benefit of lower tariffs is essentially being consumed by the rising cost of American imports and a deeply declining global export momentum due to all the logistical disruptions.
Let's pivot to Section 4, Retail Renaissance versus FII, the domestic defense of Indian capital.
Now, this is incredible to watch. We are seeing a brilliant domestic defense of Indian capital. Between January and April 2026, foreign portfolio investors dumped 1.92 lakh crore rupees. That's about $20 billion. It was literally the largest single foreign exit in history, a massive risk-off rotation driven by that expensive oil and those high valuations. But guess what? The market didn't collapse. Domestic institutional investors absorbed almost the entire withdrawal, pumping in 1.80 lakh crore rupees.
And the real hero behind this resilience? The everyday retail investor. Monthly Systematic Investment Plan, or SIP inflows, impressively remained above 25,000 crore rupees. This absolutely proves that the domestic retail bid is not just some temporary pandemic-era trend anymore. It is now a rock-solid, systemic pillar of the financial architecture, completely insulating the domestic market from global hot money flight.
Which brings us to the wild card in Section 5, the climatic floor, El Niño and agrarian inflation risk.
Just to complete this terrifying economic picture, we have a major climatic threat. For the first time in 25 years, the Indian Meteorological Department projected a deeply concerning monsoon season, just 92% of the long-period average. Look at this breakdown. There is a massive 35% probability of deficient rainfall, which basically means drought conditions, driven by El Niño. That's compared to only a 24% chance of normal rain.
This climatic threat creates a rigid inflationary floor. Think of it as a brutal economic formula. A below-normal monsoon severely damages agricultural output. Combine that with $110+ imported oil, constantly stressing the rupee, and the result? CPI inflation is projected to push well past the 6% upper tolerance band by the third quarter of 2026. It creates an environment that completely ties the hands of the central bank.
Finally, let's synthesize all of this in Section 6, the post-2026 order, resilience amid the toxic confluence.
Now, what's really interesting about this is that despite a historic currency crisis, an unprecedented energy shock, and a looming drought, the internal momentum is still there. India's FY27 GDP growth forecast remains at 6.5%. That makes India the fastest-growing major economy on Earth, growing at more than double the global rate. But, and this is the crucial bottom line, its Viksit Bharat engine is facing severe manufacturing fatigue directly because of those crippling structural energy costs.
To survive this multi-year conflict and the resulting structural realignment, the strategic consensus is that India has to lean on three vital pillars of resilience. First, energy diversification, radically accelerating solar to permanently break the crude loop. Second, trade pragmatism, carefully balancing these new U.S. agreements while capitalizing on surging exports to China. And third, domestic capital stability, fiercely protecting that retail participation that saved the markets.
So, as the economic clock of war stops ticking down and the long-term reality sets in, we are left with a massive, provocative question. In a global landscape totally defined by energy shocks, shifting trade laws, and extreme climate variables, who is actually going to maintain the fiscal credibility needed to navigate this toxic confluence? Because the side that can endure this systemic dislocation the longest is undoubtedly the side that will lead the post-2026 world. Thank you for joining me for this explainer. Keep learning, and I'll catch you in the next one.